As an option trader, I want to know what the big option players in the market are doing when they're buying, when they're selling. I'm talking Citadel, BlackRock, Two Sigma, Goldman. What are the strategies that they're using to manage their options portfolio, and what determines where they're concentrating their selling and buying pressure? In this video, we're going to be analyzing option dealer gamma concentration levels. Here's the gamma exposure data graph for the SPY. This is taking all the option contracts across every expiration all the way out in time. And we can see there are various concentrations across different strike prices. So the largest gamma concentration level is sitting here at the 440 strike price. Now imagine the SPY is trading at 430. We have negative total gamma. So as traders are buying calls here at the 440 strike level, option dealers are selling those calls to them, and they're hedging their portfolios by buying shares of the underlying security, in this case, the SPY. So imagine the stock price is trading at 430 currently. The 440 strike is going to act as a magnet for price over time. So as the stock trades up into that 440 gamma concentration level, option dealers are going to have to readjust their hedges by selling shares of the SPY to balance out their portfolios. This occurs as total gamma flips positive, and the more positive total gamma is, the more the option dealers will have to sell shares of the underlying security in order to balance out their portfolio, and this kind of causes a volatility compression, slowing price down as it goes higher and higher. Now imagine traders are going further up the options chain, buying the 445 strike, the 450 strike, the 460 strike. They're buying calls at these higher levels. As the price reaches up to the 440 strike, more calls being bought at the higher strike prices is going to actually require option dealers to buy more shares, which is offsetting the shares that they're selling to hedge at the 440 strike level. So as price is moving up into that 440 strike, what we need to know is, are traders going further up into the options chain at the 445 and 450 levels, for example, and buying more calls? If that's the case, that's going to offset a lot of that selling pressure from the dealers, causing price to continue going higher. If traders are not buying calls, then the 440 is going to act as a resistance level. An option dealer selling pressure is going to kick in, and price will likely retrace downward from the 440 strike. So you can see here we analyze the total gamma, the zero gamma levels. We look at the gamma concentrations across the strike prices here on our gamma exposure dashboard. We also have a 3D surface model where we can analyze the gamma exposures more in depth across time, so we can actually see when the big gamma concentrations are expiring further out down into the options chain. And so we use this data in our Discord to discuss potential trade ideas. So if you guys are interested, I'll put a link down in the description below where you can access this dashboard. We've got several different pricing tiers, so if you're interested, you should definitely check that out. So let me just show you a few examples of how we use this gamma exposure data. Take a look here on Tesla. On June 14th, we posted these gamma exposure data levels, and you can see here we were trading around 260 on Tesla at the time. If you look at the gamma exposure data graph, total gamma was positive. You can see this huge concentration at the 250 strike. Well, Tesla was trading at 260 and there was growing concentration at 270. So as soon as price traded through that 250 level and we saw additional call buyers coming here at 260 and again at 270, we knew that most likely price was going to continue going higher into that 270 strike level. And so let's fast forward here on the chart. Tesla kept it trading higher right into the zone. And you can see it actually traded higher than 270, traded all the way up to 275. You know, these levels are more like zones. And it didn't take long before dealer selling pressure kicked in. Tesla traded all the way down from 275 down to 250 within just a couple of days. And that was mostly due to dealer selling pressure. There was very little additional call buying above the 270 level, so there was not enough gamma pressure to bring price through that 270 strike. And so that's how we knew there was a high likelihood that the 270 was going to act as a resistance. Let's take a look at another example on NVDA. Same thing, back on May 31st, we posted our gamma concentration levels where dealers were likely selling and buying. NVIDIA was trading at the 390 level. And if we just go to the gamma exposure data graph, we can see, again, a huge gamma concentration at 450 and a ton of positive gamma here between 400 and 440. So there's a ton of call buying going on in NVIDIA. Obviously, over the past number of months, this has been the case. And so we felt like this was potentially going to be a magnet over time for price to gravitate up to that 450 level. So how did we play it? On May 31st, we posted that we liked buying the July 21st 425 450 call debit spread. Now this trade is still in play, but you can see here price traded around the 0 gamma level for about a week or two, and then boom, straight up to 440. And we think it's just a matter of time before that 450 target will be reached. Here's another example on snow. Again, on May 31st, we posted these gamma exposure data levels. Snow was trading around the 168 level, just above the 0 gamma level. And if we look here at the gamma exposure data graph, we can see 0 gamma moved up to 172. There's a lot of positive gamma. Price was trading near 0 gamma, but there was a lot of call buying coming in here at 175, 185, and the big strike at 190, which we felt was going to act as a magnet for price. And what happened? Since May 31st, price has been trading upwards until it tagged on June 15. It tagged that 190 level. Very little additional call buying took place above the 190 level. So when price started trading into that, dealer selling pressure kicked in, causing price to retrace. And it retraced about 10% within a matter of days. And so as an option trader, knowing where these gamma levels are, where concentration is sitting, and understanding where traders are buying and selling, where dealers are buying and selling, where the pressure is in the market, you can find inflection points and you can structure high probability option trades based off of those levels. So if you guys are interested in accessing our gamma exposure dashboard, I'll put a link down in the description below. You can check that out. We discuss all of our gamma exposure analysis in the Discord. Definitely want to check that out if you get a chance. Come on in, say hi. We'd love to see you. Thanks so much for watching, everybody. I'll see you guys in the next video.